Good afternoon, everyone, and thank you for joining us here today. I'm going to spend the next few minutes taking you through our recent operating performance, some of our cost initiatives, and a look at key balance sheet metrics for the company. Should I just put this down? All right. Okay. Closer? Closer that goes. All right. Even closer. Okay, here we go. Sorry. Okay, so I need to take you through the formal forward-looking statement comments. You're all familiar with those. Most of the information that I'm going to be talking about is built on a pro forma basis, as if the combined company was together as of the beginning of 2019. So just some quick highlights again. I think if you all listened to our earnings call the other day, you might be familiar with some of these numbers. For the quarter, we posted almost $500 million of net revenue. That was approximately 23% organic net revenue growth over the same period a year ago. We importantly increased adjusted EBITDA by about 12.5% to $100 million and delivered it all at a 20% net revenue margin. Similarly, if you look for the 9 months year to date, net revenue was a shade over $1.4 billion. The organic revenue growth was about 15.5% on a net revenue basis. The adjusted EBITDA growth was 33.5%, improving to $275 million, and again, all delivered at just under 20% net revenue margin. If you take a look at our performance over the most recent quarters, broken down on a pro forma quarterly basis, I just wanted to point out a couple of trends to you that are important. Since Q2 of 2020, our trailing 12-month adjusted EBITDA has increased in each and every quarter through Q3 of 2021. Importantly, again, we've increased our adjusted EBITDA margin from 16% at the end of 2019 to 20.5% ended in Q3 2021. Net revenue growth since the pandemic lows has increased in each of the 3 quarters in 2021 on a trailing 12-month basis as well. Many of you have asked us questions about our advocacy business. Zach was giving you some color on the trends in that space. In the spirit of transparency, we wanted to provide you information here for the last 3 years for this business, for Q3 and for the 9-month period, respectively. There are 2 offsetting trends that you see here. First is the more common one that everyone talks about, which is the cyclical trend of the business tied to the election cycles. Yes, that's true. But importantly, there is also a counteracting secular trend growing here, and the business is growing on a secular basis also. If you take a look at the growth in our net revenues in 2 off-cycle years, 2019 to 2021, you will see that both for the 3-month period, for the quarter, and for the 9-month period, net revenues are up approximately 90%. Switching to a different view of the business, our revenues from a geographic mix, the company on a combined basis has been predominantly North American based, with approximately 85% of the revenues being generated in North America, to a lesser extent in Europe, and then smaller pieces in the rest of the world. You've heard Mark and Jason talk to you about our desire to increase our participation in global contracts and winning global contracts, and also growing our international footprint to balance out our portfolio. So how are we going to do that? We did that with the deployment of an affiliate network. To date, we have 30 affiliate relationships and are well on our way to achieving our goal of 50 affiliate relationships in the next year. This provides us with 3 distinct advantages. The first is our speed and ability to actually service global contracts as they're won. The second is that it's a low-cost method of gaining access to international markets and serving those international clients without requiring significant amounts of capital to be deployed. And then third, it permits us the ability to cultivate these business relationships with these affiliate networks before we decide to acquire them, to make sure that it's something that both parties really want to do and gives us a greater degree of confidence in our ability that we've made a good investment. Looking at our business from another cut, from a line of business standpoint, we think that our current portfolio provides us a distinctive advantage over some of our competitive set. Approximately 48% of our business is in faster growing digital-based businesses, including digital-based business transformation and performance media, digital research, and the category that you see here as other, which includes select pre-revenue digital SaaS products, as well as our travel business. Together, it's 48% of our portfolio and a higher proportion than most of our competitive set, and we believe that will allow us to grow more quickly than our competitors. All of this leads us to increase our 2025 revenue target from $3 billion, previously stated, to now $3.4 billion. And that's built on 4 elements. The first is the higher proportion of fast-growing digital businesses. Overall, on a completely blended basis, we believe that our digital businesses will grow approximately 10 to 15% annually. Second, the topic that Jason spoke to you about, we expect to use more of our free cash flow to increase the level and increase the speed with which we will deploy capital to make acquisitions, which should give us a total of $450 million between the acquired and organic growth component of those revenues by 2025. Third, we believe that our legacy portfolio of traditional marketing assets will be able to grow more quickly, particularly with the increased growth in our global contracts. We believe that they'll be able to participate in that and will enjoy higher rates of growth than they might have otherwise. And then fourth, the topic that Zach spoke to you about, our targeted victory business, our advocacy business, where we see strong secular trends there, and we expect that growth to continue into the foreseeable future. So just switching to our synergies, we talked about the fact that the combined company should be able to achieve somewhere in the neighborhood of $30 million in synergies over a 2-year period. We continue to believe that, and that we will experience those savings over 6 categories: media, shared services, benefits, real estate, corporate, and other. The media group should make up approximately 30% of those savings, and it comes from the redeployment of resources to lower cost markets for the consolidation of the media platform and buying and the like, the reduction of duplicate tools that we use in the media business to run the business, and then finally, a reduction in duplicate roles that we may have at some of the senior levels. For shared services, we are accelerating the deployment of our Maconomy ERP system globally. This will allow us to, A, reduce costs from the technology standpoint, but more importantly, it also permits us to accelerate the consolidation of the back office and AR, AP, bill pay functions, and to redeploy that talent to lower cost markets and achieve even greater savings. And finally, we think we can also use the platform to reduce third-party spending in legal. Real estate. We see further opportunities in real estate. You're sitting in a One World Trade Center space today. This is the project which was our real estate transformation project, which we completed in the 3rd quarter of 2020, which has allowed us to save approximately $10 million a year in real estate. But we see additional opportunities for maybe another $3.5 to $5 million across North America in markets like Los Angeles, Denver, Minneapolis, Toronto, and even more opportunity in New York, where we haven't consolidated as much as we think we can. Benefits. The size of the company is significantly larger now. We believe the increased scale will allow us to do two things. One, lower the cost of our employee benefit programs because of that scale, self-insurance and the like, and also the deployment of a common HR and payroll system, which will reduce our technology costs and admin costs. Nothing is left untouched. There are opportunities in corporate as well to reduce duplicative roles and to reallocate resources to other areas of the business where the talent could be used more efficiently. And then finally, third-party spend recapture and G&A. And this really comes from sort of enterprise-level contracts that we enter into for technology, hardware, software, business insurance, and the like. We believe that we can use the scale to reduce the spend in all of these areas. So shifting to our balance sheet. The combination provided a significant deleveraging event for the company. Prior, MDC had approximately 3.9 times leverage at June 30th. The merger, now on a post-combination basis as of September 30th, we are at 3 times leverage. We have significantly improved the strength of our balance sheet with this transaction. The rating agencies seem to agree. They have both increased their ratings for us by 1 notch and have us on positive outlook for the future. We continue to believe that we can run the company at 3 times based on some of the remarks that Mark made, but we believe we have significant cash flow that we can use to fund the activities in the M&A that we'd like to do with that cash flow, as well as our existing facilities. So just looking at our debt and our capital structure, our net debt today is, as of June 30th, is approximately $1.27 billion. Importantly, as soon as we consummated the merger, we went out and we immediately took advantage of the interest rate environment, and we refinanced our existing senior notes and expanded it with a new $1.1 billion issue of 8-year notes. This did 2 important things at the same time. The first is it lowered our annual interest costs by approximately $17 million on a comparable balance basis, but it also increased the stability of our balance sheet with permanent, low-cost, 8-year notes on the balance sheet. Shifting to our capital structure, we've done some extra things to improve the balance sheet further here. We recently called our convertible preferred notes and converted them into approximately 33 million common shares. This, again, improved the balance sheet in 2 ways. The first, it eliminated future accretion on the convertible preferred notes, basically mitigating the possibility of up to $23 million more of accretion that could have taken place over the remaining period of the notes. And secondly, it simplified our balance sheet structure and our capital structure. On a fully diluted basis, we're at approximately 295 million shares, including outstanding awards to employees in the company. So just to reiterate in conclusion, a couple of things that we want to just revisit on the targets. Our annual revenue growth is now set at 7 to 9% organically. We expect to acquire and grow organically with $450 million in acquisitions. We have targeted revenue for 2025 of $3.4 billion. We expect that we can continue to run free cash flow at approximately 50% of adjusted EBITDA, 50 to 55% of adjusted EBITDA. We think there's more opportunity for margin expansion, and we think that over this time period, we can expand margins by 25 to 50 basis points a year. And we expect to run with cash taxes over the next couple of years of somewhere in the neighborhood of 21 to 24% of pre-tax income. We'll continue to communicate with you frequently and transparently. We've listed the KPIs here that we think that are important to measure our progress and our success. And that brings me to the close of my prepared remarks. And with that, I'm going to turn it back over to our CEO, Mark Penn.
Thank you.
Go ahead, Mark.
Yes. No? Yes. All right. I just wanted to point out, in conclusion, before we take some Q&A, that you should think about, we're not up to providing guidance into the next year, but I think we should definitely point out some of the obvious in terms of what's coming up for us. Obviously, we're going through the down part of the cycle. When in the next quarter, you'll have the absence of the political cycle, but going into 2022, you will have what promises to be a fulsome cycle of advocacy. I think that we're seeing continued demand in the digital transformation area. We don't see any real let up in the kind of growth that we've seen coming out of the pandemic. That there's been, as you can tell from this meeting, we have people here, but we have many more people not here on the web stream. And that, the hybrid life that still accelerates digital and means that every company has to put more into adaptation seems to be continuing. The integrated offerings on digital media continue to scale up. As they scale up, we have more scaled clients. More scaled clients, greater efficiency, greater margin, greater ability to grow. Our current numbers still have travel mostly depressed. So as you recall, we have a travel business. It has relationships with 22 airlines. It actually, during the pandemic, as people moved off of magazines, has created a new database product, which takes airline passenger information for retargeting, and we're rolling that out to airlines. And we picked up most of the CNN screens across the country in key locations, and so we've created, we now have Reach TV, are basically our own TV channel that goes through the 3,500 screens and now is open for advertising. As travel comes back next year, that business will resume. And finally, experiential, although experiential is a small part of the business, that is also a business that will spring back in 2022. So I just wanted to point out that we, if you liked this year's numbers, we have a bunch of stuff coming, for next year that I think promises to continue, the kind of growth that we've shown. So with that, let me get everybody up to take some Q&A. Are we taking 3 minutes to set up, or we're just Q&Aing?
I think we're taking questions from the live stream and also in the room. And I think, Michaela, you're filtering the questions. Oh, sorry. Beth is filtering the questions. My apologies.
Okay. First question from RBC. You've laid out a very attractive path ahead towards executing against your 7 to 9% long-term organic growth target. Whether it's with a large and growing TAM or continuing to grow your share, how should we think about what specific drivers could drive upside beyond your best case organic growth outlook?
Ooh, I like that. I love. So I think there are a couple of things that would drive above expectations. One would be snowballing of large-scale contracts. Number of individual contracts we have in the $25 to $50 million category right now, 0. Number of growing contracts in the $10 million category, pretty rapidly growing. We've had 4 or 5 wins, in that, come now. So once we get into $25 million chunks, those snowball because every win is a stream of multi-year, and the larger the stream, the more difficult it is to untangle, so the longer actually the longevity is. Second, we could have a hit in the Stagwell in the Stagwell cloud. If you think about it, if I got to 100 million of revenue, that probably would create about $1 billion of value by itself, because of the way that SaaS revenue in that space, has typically been valued. So I think, and the third thing is really just the continued, digital expansion. I have us at 7 to 9. You've seen a lot of agencies have been growing here 50 and 40 to 60%. If we're able to execute some continued expansions as we scale up in that way, we are still far removed from the biggest agencies and have those capabilities. I don't know if anyone else wants to throw in another above average. And I think that I don't think there can be more spending in advocacy than Zach has predicted.
Okay. From Mayborn, please provide more specifics on the changes in incentive programs and earn-ins versus historical earn-out philosophy / obligations.
So it's a good question. I think what we've seen in the legacy MDC group was a heavy focus on deferred acquisition consideration, even as opposed to legacy Stagwell, where there was not a lot of focus on that. We've primarily done buyouts, as Jason mentioned, at scale, sort of at closing. I think what we're now looking at in terms of the incentives going forward is really this idea of an earn-in, and I think Mark mentioned that on the slide, is that a sharing of the growth that these entrepreneurs put up and that they receive primarily in the stock of the company. I think you're looking at a group of people who own a lot of shares of the company right now. I think as you saw from the transaction closing, the legacy Stagwell managers earned about $19 million of the shares in the company. So there's a large incentive for them to continue. Some of the other people that were that came from the other side also have large amounts of shares in the company. So we're moving away primarily just from DAC at scale, and then moving to something that is more earn-in oriented, less earn-out oriented. And I think that is actually hopefully more attractive and something that drives the behavior of more integration, more cooperation than just focusing just on their own P&Ls and businesses.
That was 19 million shares.
19 million shares.
Yeah.
Okay, we have a 3-part question from Steve Cahall at Wells Fargo, so I'll read them individually. First, I know the 7 to 9% is a target and not guidance, but given your digital foundation, I think that's what investors will expect. So are you confident in growing 7 to 9% or better near term, since that's likely to be the benchmark for gaining investor confidence?
Well, I think that since I really became CEO of these assets and have managed it, we have really taken what I think has been an on-target approach, to predicting as compared to I think the past. And so I felt comfortable when you analyze the situation, run through the numbers. I didn't take 7 to 9, after having sat through kind of 6 to 10 review meetings, having gone through the percentage of high growth digital and having gone through the marketplaces. Yes, I'm confident in the 7 to 9 as a benchmark. Is there, again, people are interested in upside. People always want more. I always resist promising more. I think that we're showing really strong wins coming out of the gate in the merger. But I think that's where I'm quite comfortable with a really substantiated, prediction. I think the 5% before was even more conservative, given that we see the kind of growth drivers that we really have here. So I feel confident in it, or I wouldn't have done it. And you're not going to get me to say something more because I would have said it, but I'm not.
Second question from Steve. How do you think about balancing deleveraging versus your $450 million M&A target? Is deleveraging the number one priority or only after debt reduction?
You want to take that? This guy's right. Look, I think what I said, if I can borrow money at 4 or 5% and I can invest it at 20 to 40%, or in the example 10 to 1, are there investment opportunities for us to grow this network? We can't sit here at $2 billion. We have to get to 3, 4, and 5. We have to continue to scale up to get in as one of these, 5 to 10 of these top pitches that we're not in, right? And so that means scaling this out and investing wisely. And I think, as Jason illustrated, we have a very good track record. I don't like to overpay. I like I like to have judicious elements that promote common growth. I'm not creating a bunch of competitors so that you drop new business in and it's piranhas fighting for it. Instead, it's a collegium and a cooperative team. So bottom line is, I think we don't want to do what was done in the past and over leverage. We don't want to under leverage, because there are real growth opportunities here in the marketplace. There's an entire international marketplace that the big companies have not made much investment in. Why? Because they bought their Dubai affiliate 40 years ago. Well, since then, there are tremendous new digital-first opportunities in these countries that we can now scour for fresh investment and add to a platform, because A, they need to be added to a platform to grow, and B, there's nobody else out there in that marketplace right now. So I think the opportunities are really strong and sound, and I think the balance, look, and you saw with Stagwell, we came in with relatively low debt, despite the fact that we were in the business of acquiring, investing, and growing, because I manage this stuff prudently. You also look at a P&L in which we're achieving right now a 20% margin, and you have EBITDA in the, approaching 400 million. So this is not only, I like not only to grow a company, not only to kind of find serious growth avenues, but I also like to make profits and cash, because we can take that cash and we can continue to grow this from a $2 billion platform on in this marketplace that needs transformation.
Got it. And the third question is, do you feel as though any of the legacy MDC agencies have been negatively impacted by the merger and uncertainty of the last few years?
Well, I think that they've been positively impacted. I think that when we came, a lot of the founders were leaving. There was talk of breakup. I think the founders have come back and been re-energized. They've got broader jobs. I think a lot of the companies have been re-energized. I think it's been a strong positive for those companies, and the fact that they can go in now, combined with media, combined with digital, the digital expertise that they need, also I think has re-energized them. Now, not every company has done perfectly, but by and large, and I think you saw a very strong presentation from Carl Johnson Anomaly, very strong emphasis on optimism out in 72. I think you've seen Donor, hit kind of the Main Street stuff. I think every one of these assets, has its particular strength and specialty, and we work to kind of get the maximum out of them and to promote a positive culture. Crispin obviously was an agency that didn't, continue to perform as strongly, but the attitude we've taken is to bring in a new team, bring in a new management, and we're confident that we're going to see that one be revived. I don't know, Jay, if you want to add.
We have some people who came over from legacy MDC. I don't know if they want to comment.
I think one thing I'm particularly interested is the whole M&A thing is becoming a reality. So I came from the MDC side, YML, worked with MDC for 4 or 5 years, and there was a lot of conversation with very little action. And I can see that how that is changing, and I'm pretty optimistic and excited about that.
I mean, the only thing that I would add is that you know, in the new world that we're in right now, we're really seeing a more collaborative environment for the CEOs that were on the MDC side. You know, we were really at arm's length. I think the way that we have been engaged in our opinions and the meetings and the business leadership team that Mark showed really allows us to contribute more to kind of the future direction, which frankly just means we're more bought in to what we're creating together.
Okay, our next question. The company has already reached its objective for an approximately 3x leverage ratio and will generate significant free cash flow over the 2021 to 2025 period at an approximately 55% conversion ratio on adjusted EBITDA. Does the M&A contemplated in your plan utilize all of this expected free cash flow? If not, where might excess free cash flow be deployed? Mike?
I think it's a good question. I think it's a little premature for me to answer that. I think our first emphasis here is on scoping out M&A, and you know, obviously, things will then automatically fall to reduce the debt ratio. Whether we do anything else, I think it's premature.